This week on Mavens of Data, we're speaking with Jason Strimpel about how your data science skills transfer for algorithmic trading, including reproducibility and backtesting discipline being a data scientist's secret weapon, some common pitfalls when transitioning into quant roles, and tools and workflows you can use to get started fast. Hope you enjoy this episode. Welcome, Jason. Thank you so much for joining. If you could say hello and then maybe give us a quick rundown of your background.
Sure. Hi, Kristen, and it's a pleasure to see you all. Thanks for hosting. So I am Jason Strimpel, founder here at PyQuant News. My background has been in the markets for probably 25-ish years, probably closer to 20 years. I've been a technology person for probably 25 years. So always at the intersection of both. Did hedge fund trading for a while. I was a derivatives quant, credit market risk in Chicago. Moved to London, did the same thing. Moved to Singapore, did the same thing. About 10 years ago or so, maybe 7 years ago, I got more formally into the technology space. I did a stint at a big mining trading company in Singapore where I spun up their data analytics and machine learning engineering function there, and ended up at AWS for 4 years building analytics systems, machine learning systems for big capital markets companies down in Southeast Asia. And most recently joined as managing director of AI and advanced analytics at a big consulting firm here in the US. And I did finish a master's degree in quantitative finance in 2013.
That's awesome. And it's a lot. And so, you've obviously worked at a hedge fund. You've also worked with data scientists. So what do you see as immediately as the transferable skills that data scientists can take that will help them in the quant world?
Yeah, well, there's probably the technical side, and then there's more the maybe philosophical side. The technical side is obviously working with the tools around data, working with data. And I think most importantly, it's how to understand and interpret results. Nowadays, we have libraries for everything. So you just plug a data frame into some library and you get your test results. But how do you interpret those results in the context of the domain or the business problem you're trying to face, right? Very, very important. So having the discipline, having the rigor, having the toolkit and the tools around that is very transferable. I would say that data science is a little bit more tilted towards statistical analysis, whereas quantitative finance is typically thought of more towards things like stochastic calculus. So the actual math underneath is a little bit different, but I think it's something that one could pick up. Not that you could just pick up stochastic calculus, but the mental model is there. You've got the rigor, you've got the analytical frameworks mentally to kind of pick up a new technical discipline. And then I think the other part more philosophically is how do you take theory and then apply tools to make that theory come to life, right? Which is hard for people to grasp. And with that comes this kind of ideas of probabilities. A lot of what we do in quant and trading specifically is around probabilities, probability distributions, and thinking in bets, if you will, where you kind of are thinking in the same way of statistics. You don't have, it's not E equals MC squared. This is not physics. You actually have to think in kind of distributions.
Awesome. Yeah, no. And with the interpreting results too, I think as a data scientist, I know at least for myself, it was really exciting because I start getting that output and I look at it and I'm like, I have no idea what these charts mean, but I really want to know. I really want to know what these metrics are, and I want to understand which ones are important, and I want to sink my teeth into that. And that's still, it's something that I'm working on because there's a lot of them. Yeah. So how is building a trading strategy similar to building machine learning models?
Good question. I think the lowest common denominator between the two goes back to something like the scientific process, right? And I don't claim to strictly follow the scientific process in anything I do, but you have an observation that's interesting to you. So either it's something you're seeing in the data, or it's some interesting problem that you're facing, or it's some anomaly in the market. You collect data, you test, you form a hypothesis, you collect data, you test your hypothesis, and then you draw a conclusion. And the thing I like to think about is you're never proving anything in statistics, right? That's why it's called rejecting the null as opposed to accepting the alternative, because you're not actually accepting anything. You're just collecting evidence to suggest something is true or not. Trading is the same. There's no closed form solution for the markets. So the only thing you can do is collect evidence to suggest what you're seeing is statistically significant, or that it's like some pattern. So I think the process that you can follow is similar in that sense, where you make an observation, you collect data, you form a hypothesis, you test your hypothesis, and then you actually collect evidence to suggest you're right or wrong. And in the markets, it's great because it's immediate and it's money. So if you're losing, it's very painful very quickly. I mean, you kind of get over that after a while, but it's painful. Yeah, you do. After a while, the P&L just becomes another diagnostic, honestly. And that's the way I started thinking about it a long time ago. If I'm making money, great. If I'm losing money, not great, but okay. It's another data point to tell me something. Mm-hmm. So I like to think about this all as similar to the scientific process.
Yeah, no, I love that. Well, and so my current strategy that, you and Matt put together is like actually using XGBoost. So it is the whole machine learning pipeline. And then, if I don't like the results, I'm literally just adding new parameters, removing other parameters, and like tweaking things to it's model tuning, just like we do. And so what does the role of like data cleaning and feature engineering look like for these trading strategies that you create?
Another great question. The data as we all know, like you go to some academic program and you get this pristine data set, like the Iris data set or the Titanic data set, that's never that clean in reality, as we all know as data people. I think in the markets, it's super messy. It's never standardized. You have different resolutions. You have non-standard formatting and all these kinds of things. And the problem with financial market data is that price data has memory, which is what you want in your data set, because then you can find patterns, but there's no stationarity. So the moments of the distribution are not stationary, they change through time. So all of the statistical assumptions that we have in time series modeling break immediately because of this problem. If you normalize the prices to something like returns, that's great, you have stationarity, but you lose all the memory. So you've got this like really interesting trade-off in financial market data, that you either have memory and no stationarity, or you have the exact opposite. So one of the biggest things that you have to worry about is that balance. How do you modify your asset price data so that you have some memory, but you have some stationary, so you can actually use some of these tests? And that's really like the biggest challenge that we face with financial market data, aside from the normal data cleaning issues, right? So a great example with data cleaning is a symbol change. So Facebook used to trade as FB, and then it changed to Meta. So what happens is if you try to run a back test and you run a back test with Meta, the symbol, your back test will only go back to where Meta was Meta and not Facebook. But the fact is, you should also include prices from when it was Facebook as well. So there's an interesting challenge there. The other is what we call survivorship bias. So Enron, big company, went bankrupt. If you look at the composition of the market today, you will not include a stock that went bankrupt like Enron. However, if you looked at the composition of the market 20 years ago, you would have included Enron and you would have lost all your money. So you've got this very unique and very challenging data problem around this type of thing that you have to deal with. And that problem manifests itself in your P&L. So if you backtest this thing you have this performance that's like 25%, for example, and then you trade it live and your performance is half of that, you've got a problem. The final thing I'll say, this is a huge topic. The final thing I'll say is when you're running these kind of statistical tests, you have overfitting, which we do in every model.
Mm-hmm.
But because the market data is so random and there's so little signal, you will overfit frequently and you will be fooled into believing you actually have something working, because you take those results and you pass them to this backtesting mechanism, which will give you this P&L, and you're like, oh, I've got a positive P&L. This is amazing. When in reality, you've just completely overfit. Even if you haven't overfit, you could just be getting lucky. And maybe you're making money and you feel great about life, but you're making money because you're getting lucky and you're not actually finding any sort of pattern. So it's a very, very challenging thing to work with the data. So actually, I think it's very different than maybe a typical machine learning or data science problem where you have cross-panel data. This is all time series data as well. So it's a little bit of a challenge.
Yeah, I mean, there are similarities in the sense that like most models degrade once they're in production. Absolutely love hearing about it just feels good to talk about data cleaning and like concrete examples that we see. And then if I could just ask real quickly, what is one of the biggest indicators to you that you're overfitting your model?
You should just assume you're overfitting your model. Honestly, a positive P&L. If you're getting a consistent like positive outcome, you should be very skeptical of that. We do things like a parameter robustness. So if you change your input parameter by a little bit and your kind of output swings around a lot, meaning your outputs are very sensitive to your inputs, that's a good sign. It's a red flag. I will typically do one-sided t-tests, like the t-test we learn in statistics, where I will check to see if there's statistical significance in a single metric after running a bunch of simulations. That's another good way to do it. We talk a lot about this thing called information coefficient in what we're doing, Kristen. So there's something there as well where you can basically test the t-stat and the p value of what we call the information coefficient. So there's a couple ways that I typically look at, and you will most always be overfitting in a certain class of strategy, which is why I don't trade those strategies. When we look at the factor-based strategies, there's a lot less opportunity to overfit. So different classes of strategies have different opportunities to overfit, if you will.
Awesome. And so given all these things, what are some of the biggest mental adjustments? If somebody is a data scientist, they want to try algorithmic trading, like what are some of the things that they need to think about and maybe make a mindset shift?
Yeah, we were kind of talking about this before we went on, but I think I'll just kind of repeat what we talked about earlier. There's a beauty in mathematics, and there's a beauty in statistics, and there's a beauty in analyzing data and having this output and having all the test statistics kind of point in the direction that you were hoping, right? That's the data science world. Markets are very, very messy. I always joke with Matt that, data science people's code always looks very clean. Quant code is very, very messy, because we're optimizing for something different. We're optimizing for getting trades in the market. We're not optimizing for reproducibility or beauty in the analysis. We just want trades in the market. So there's kind of a gap between all of the time and energy spent on this analysis, putting it into the market only to seeing it blow up, not work, fail very quickly. So in my view, and not only that, but you're putting money at risk. And people have a very deep ego thing with money. And the faster you can separate that, the better. But the big gap is to spend a whole bunch of time on this pretty analysis that you think just because you spent a lot of time on it will work, and it doesn't work. Strategies, you have to iterate very, very quickly. So I think the biggest mindset shift is like just getting something working, building like templates and infrastructure that helps you just plug and play as fast as you can. Because the faster you can iterate on different models, different strategies, the faster you're going to find something that works. And if you don't like the journey, like the stoicism, if you don't like the journey, this is hard because you have to keep repeating the thing over and over again. If you like the journey, then it's great because you have to keep repeating the thing over and over again. So for data scientists, I think it's getting over the overwhelm of the markets, right? There's the emotional thing with putting your money at risk. And there's the mental model of being a little bit more scrappy and less pristine with your analysis, just to get those analyses in the market.
It makes me think about every time I've seen Matt Dancho code, I'm like, wow, that is beautiful. He is a well-organized man.
Yeah, his code always looks very good. Mine.
Yeah, it always looks good. So you touched a bit on how, right, like how data analysis was sort of different. Can you touch a little bit more on how like you need to rethink metrics when success is measured in returns rather than like we're just looking to optimize a loss function? Like what's the difference there?
Yeah, there's probably like two buckets. There's bucket one, which, and again, I'm overgeneralizing here, but at the same time, I'm like imagining a certain class of strategies where you're using machine learning to build these strategies, like factor strategies that we talk about in the thing with Matt. There's the actual machine learning workflow, which is very similar to what the data science community will recognize. So collecting data, finding a feature, finding several features, going through the training process, understanding the statistical dynamics of that feature, right? The part that is different with Quant is that you then take that analysis and you plug it into a so-called backtest framework. And what the backtest does is it simulates a trading strategy on prior market data. So you're basically feeding in market data from 20 years ago into your strategy that you built today to see how it behaves over time. And then you take that train down the tracks, so from 20 years ago all the way through today, and you see what the dynamics of that strategy look like over that long period of time. And the whole suite of analytics that you will look at are not like your F scores or your R squared or statistical tests, but they're actually the dynamics of the trading strategy itself. So P&L, things like, and I'm going to say a bunch of words that maybe your audience have never heard of before, which is kind of the point. But there's P&L, there's drawdown, there's risk, Sharpe ratio, Sortino, Calmer, like all of these different strategy specific metrics that tell you the dynamics of how the actual trading strategy has performed against the market. So that is like the second bucket. And when you're going through this process, it's not necessarily rethinking the metrics. You just need to learn a new suite of metrics and paint the picture. I always like to say no one metric is going to tell you the whole story. You need to paint the picture. So for example, like you all know skew and kurtosis. If you have a negative skew, that means the returns, you have negative fat tails, right? Or you have more mass on the distribution on the downside, which is telling you something. You might have big losses, which has a very real implication. Because if you imagine if you're trading and you make $1 a trade and you make 1,000 trades and you make $1 without losing a single time, great. But then you have one trade where you lose $1,000. You've just wiped out your entire P&L in one trade. That's bad. So you have to actually put in real life risk management techniques, right? And so you're taking the statistical analysis, you're building the strategy with that statistical analysis, and then you're taking it through a separate step, which generates a bunch of risk metrics and different types of metrics that you then have to actually take action against.
And so if somebody actually wanted to start playing with all of this and starting to learn the metrics, or more so playing with it, what tools would you recommend they go to first? Because there's so many tools, and then I feel like on YouTube you watch and you're like, okay, I only got like a 15-minute video, and you don't know if that tool is going to work kindly with another tool. Like what would be your recommended go-tos?
As a start, I mean, Pandas is the de facto data management tool, and you can actually do a ton of stuff just with Pandas. Obviously, there's polars, there's all flavors of this. If you're an R person, there's, the R data frame.
Yeah.
Exactly. I always recommend keeping it simple to start, and what I call MVP. So I'm a Python person, so minimum viable Python. Like, what's the minimum code you can write to get some result, to get something that gives you a directional view? So an example is like, you can run a backtest in a Pandas data frame. There's stuff that's wrong with it, but if you're running this thing and there is zero evidence that there's any sort of performance edge, then you could abandon it very quickly. Whereas if you spend 3 months building it in this beautiful, robust backtesting framework, and you've wasted 3 months on something that doesn't work, right? So I always suggest getting very familiar with the data, the market data. If you're brand new to the markets, like, just go out to Y Finance. I'll just type it in the chat here. Is a great library. This is kind of the de facto Python library that you can use to download historical market data. There's another package called OpenBB, very similar in concept, but it just has a broader range of data. Just start exploring, like data scientists love to do, exploratory data analysis. Get a feeling for what this data looks like. Run some basic time series analyses on it. Prove to yourself that the distributions are not stationary. Prove to yourselves that normalizing destroys memory. Like, get familiar with the underlying data. Now, if you want to move to backtesting, the backtesting framework that is very similar to NumPy and Pandas is called VectorBT. If you go to my website, I do teach a course. I talk about all of this in depth. You can read one of my 165 newsletters as well and get all this stuff for free. But getting the data, VectorBT is a very good vectorized backtesting engine that will get you started very quickly running a simple backtest. And you can kind of feel what it's like. You can get some of these performance metrics that I'm talking about. And between those 2-3 tools, you can spend months. Like, you don't need much more.
Awesome. So somebody starts using those tools, they're trying to back test data. From your experience, what are the first mistakes they're going to make?
Technical analysis is one. So technical analysis is like filters, basically. You've got a simple moving average, which is exactly what it sounds like. And you would be shocked that people take a 50-period moving average and a 200-day period moving average. And when the 50 crosses the 200, they buy. And when the 50 crosses below the 200, they sell. That's an example. So technical analysis, in my view, is prone for overfitting. So if you were to try to run some brute force optimization and get the parameter set that makes that look good, you are probably overfitting. So I would definitely kind of avoid that. But if you wanted, sorry, I've totally lost the question. I'm trying to stall so you can repeat the question.
No worries. Do you want me to repeat it? So basically, what are the common mistakes you see people making?
Okay, thank you. I think that's the most common mistake, right? It's like, give me some simple technical analysis strategy. Let me, and forgive me if your audience doesn't know what technical analysis is, I'll just put it in the chat. I forgot the S at the end, but you guys get the idea. Just Google it. There's all these indicators. There's this entire industry around technical analysis. There's books that are that thick. And what folks do is they brute force optimize the parameter set that maximizes some or minimizes some loss function, basically maximizes some profit metric. And what you've actually done is overfit. So that is the biggest mistake. I think the other big failure mode is not linking a strategy to economic reality. So I post frequently on Twitter, and I post this Venn diagram of like programming skills, mathematics, and market experience. And the programming and the mathematics is like, okay, but like you have to have that market intuition as well. You have to know the domain, basically.
Mhm.
So the failure mode I see people doing is not having a strategy that's linked to the economic reality and just thinking that they can brute force optimize some input parameters and then take those input parameters as generalizable into the future. When really what you've done is overfit. Number one mistake that folks make.
I've totally done that. I have Adam Grimes, is that his name? Technical analysis book. Absolutely, 100%. Okay, and so you mentioned that, learning the domain is one of the big pieces. And I'm like also guilty of being somebody who has the Python, I have the math, and like the market piece is slowly coming. Do you have recommendations for resources if people wanted? Obviously, PyQuant News. But do you have any additional ideas for where people could start to pick that up?
It's a good question. I think there's kind of two. I'm all about buckets. There's kind of two buckets, right? There's like the overall market, and what is the market, and what does happens in the market, and what is a risk premium, and like more of the theoretical constructs that guide a lot of decision making in the markets. And then there's the actual like low level technical data manipulation, like data cleaning, data staging. And I think most people like us who like the tooling and the data kind of go here, where we immediately do what I just said, download data, start looking at it. But I think there's a big part of more of the philosophical way that markets work and the decision-making process that goes into the markets, I think is a part that most people miss when they think about the domain. There's a lot of really heavy resources out there, like financial theory. Like I did a master's degree in this stuff, and it gets very theoretical and very dense. I think my course is really, really good, and this is not a pitch for my course, but it's
You
a really
can plug your course. That's okay too.
what I've tried to do here is just make it super practical, and conceptual, and then show how the tooling fits into that conceptual framework. And this is why I built the course, because I thought it was missing. You don't want to sit down and read 1,000-page textbook on all of the different risk premia that exist in the world, which I have done. I had to do that for my master's degree. You might want to, but it's a painful experience if you're not a finance person. But that's the type of thing that folks typically miss. So when we talk about the market intuition, it's like stocks tend to go up. Well, why do stocks tend to go up? Or what is the futures curve? Why is it in backwardation? Or why is it in contango? Like how does the supply and demand of commodities impact futures prices? Like the actual in real life reality, how that applies to this abstract notion of the financial markets. So as far as like resources go, again, I'm obviously going to say my course I think is quite good. Pick a stock and just follow it and just watch it and just read the news and read earnings reports and learn about it. I think is another really great way to kind of break in. Lots of good YouTube videos. Try to get the ones that are not promising 1,000% returns, just like more of the theory. Read the PyQuant newsletter. Stick around with you, Kristen, and my stuff as well. I think we post a lot of good resources. It's all a good spot.
All right. Awesome. So I think we have one more question before we head over to Q&A. Do you think AI will make the quant role more accessible to people or to data scientists, or do you think it's going to make it more competitive in a way that's going to be prohibitive?
I'm going to pivot that question and answer
Sure.
it. I think it'll probably separate the big winners that are already winning from everybody else. And then everybody else is kind of in that bucket that you just described. Yes, like AI, LLMs, ChatGPT is actually, it's an incredible resource for getting intuition behind why a particular strategy works. AI is used to kind of extract new information from unstructured data and turn that new information into sources of edge, i.e. new factors, new features, right? So you have this corpus of text data that you couldn't previously translate to numerical features. Now you can with LLMs. That's a very interesting area of research, but you and I are going to struggle to do that at scale. Whereas the big money managers and institutions are able to afford to do that at scale. So that's kind of what I mean as an example of separating. Now, all of us, right? Yes, like if you go to ChatGPT and explain the crack spread to me. Yes, that's an actual thing, the crack spread. You're going to get a very good explanation of the crack spread, why it works. And you're going to ask, what is the economic reality here? What is the link? So I think that's very, very good. I think obviously with all the code gen that is available now, these models know a lot about the tools of the trade for Quant, and you can ask it to help you along with Vector VT, help you along with Zipline Reloaded, some of the other tools. I think that's also a very good source of information. So to answer your question more succinctly, which I feel like I'm not doing, is I think it will lower the barrier for folks that are already technical and technically minded to get into this field. Yes. And then at the same time, I think it will separate even further the large institutions from folks like us.
Right, because when you're talking about at scale, you're not talking about creating a couple features based on the unstructured data. You're talking about like a whole world of data.
About like, famous hedge funds are known to collect every source of economic information globally every day, petabytes of data every day.
Yeah.
Like we're not doing that.
No.
We're also not managing tens of billions of dollars of assets, and we don't have hundreds of millions of dollars a year to spend on this stuff. That's what I'm talking.
Yeah, no, and I'll probably go and find some type of that data at some point and add like 3 additional features as a pet project.
Yeah. like to like maybe a gigabyte of PDF statements that you can run through overnight, an LLM, and it'll cost you like $75 for all the tokens you use, but to like pull some features out. But even then, like you're still separating yourself from the average retail investor, right? So there's millions of retail investors in the world that are all looking only at prices. Everybody has the same price data. Everybody has the same Python libraries. Everybody has the same everything. There's only a finite number of ideas against the same data, right? So if you have a new additional source of alpha through a new innovative block or corpus of data that you can turn into a feature, then you're separating yourself, right? And if you can take advantage, and that is the entire game. That's exactly what we're trying to do here. And that's why another reason I think data scientists make a great quant is because they have the mind to do this.
And truly enjoy making features.
Yes.
Are you ready for Q&A?
I'd love to. Yeah, let's do it.
All right, awesome. So Bart has asked, can you freelance with algorithmic trading? If so, how do you start? What skills do you need to focus on?
Ooh, freelance. That's an interesting question. So I can take it a couple ways. Like I can take freelance from the context of like trading yourself. That's what I think you mean, maybe. I can also take that as like I'm going to provide consulting services or courses to others. I do both. So yes, I think the hobbyist now has access to very powerful and very potent tools to do this work. We kind of talked about the best way to start. Unfortunately, it's not like a book you can read in a weekend. It's intuition, it's experience, it's exposure, it's taking your lumps, it's losing money in the markets. It's like actually getting into it. The course that I teach, I think, is a really great way to start doing that. If you already know Python, just going to plug it again. There's probably the best place to start is just to start doing it. to get data in, getting yourself a brokerage account, funding it with like $500 or $1,000, just to start to get that market intuition of actually placing trades, see what it feels like. You can also separate the two. It does not have to be fully automated. You can do your analysis over here and spit out, buy this, sell that, buy this, sell that, and just go manually plug the stuff in. It doesn't have to be fancy. That's probably the best way to start, is just to get in there and do it.
Yep. And that's exactly where I am too. Like, I opened up a trading account. I put a little over $500 in there, and I haven't traded a cent yet because I've been paper trading.
Yes.
So I'm trading fake money, and I'm just following how did I do? And I'm just learning all the dumb things that I'm doing along the way. And then I'm doing different stuff. And it's like super fun, but I haven't actually made any live trades yet.
Yeah, risk-free. That's the best way to do it.
Yep. Okay, this question is from Bob. Would you pull out unicorn events like 9/11, the Great Recession, and COVID? Or would you strata the model for reasonable events versus black swan events?
Yeah, there's two schools of thought here. I'm inferring, or maybe there's a slight implication there around the black swan events, around like anomalies in the market that you want to take out in the case of like a time series analysis. Maybe that's kind of where this is going. In general, time series models don't work well on financial market data for reasons I explained earlier, the stationarity issue and the memory issue. So typically, we're not focusing that much on time series models. The way that you would generally deal with these is consider them stress events. And if you think of like a K-folds validation, right? A K-folds, so you take like a block of data, and you take a block of data, and you take a block of data. In finance, we call that a walk-forward analysis. And what we're calling these events that you're describing are regimes, or regimes is probably the best way to say it. So like COVID is a good example on both the downside and the upside. The upside being, during COVID, every work from home stock rallied, like Peloton, Zoom, because nobody thought anybody was leaving the house again. In the last 10 or 15 years, we've been in an ultra low interest rate environment. That has a very strong implication to asset markets. Recently, last couple of years, it's been a higher or normalized interest rate market. So two different regimes. So I'm giving this context because the way that we typically handle what you're describing is two ways. Number one is stress events. So we will take the time around the event with the benefit of hindsight to see how a market portfolio performed during that event. So then, you know, as institutional knowledge, if that event occurs in the future, what you might expect. Okay. Now, that's not very rigorous. It's just more of a tool to give you some of that intuition. The more rigorous approach is to do this walk forward analysis, which essentially destroys different market regimes, because you can also overfit to a market regime. So in the 2 or 3, 4 years of COVID, you would have like a K-folds walkthrough of like 5 or 6 different overlapping chunks of data, so that that particular fold doesn't know anything about that particular market regime. And then over all of the folds, you can take the average or median of the outcomes, and it just kind of destroys that particular overfitting to that regime. I know it was a little dense and a little bit long. Hopefully that answered your question.
I loved it.
Long story short, you would not pull them out.
Oh. So this is from Sharu, and he was just wondering if you had any insight on transitioning from being a data analyst to being a data scientist.
Probably a better one for you.
I know. Not I know, but I saw it and I was like, okay. But Sharu, yeah, just wanted to answer your question. So for me personally, I looked for opportunities to do modeling when I was a data analyst, and I highlighted them looking very nice on my resume is what I did. And the things that I didn't want to do in the future, I didn't highlight those. So if I spent a lot of time, you know, managing the tagging of different pages or whatever, like, you know, different things that you take on at some point, like those bullets did not exist on my resume, so that my resume started to look like a data scientist resume. And then like I strategically positioned myself and sort of like rebranded. And then I went for data scientist roles. And so, yeah, so if you don't have it yet, I'd go for, Python, start like building up a portfolio where you're actually building models. There's fantastic data sets out there that are free and are easy for you to get at. So there's like the IBM attrition data set, so that, there's customer lifetime value data out there. There's retention data. Start doing models that are based on actual projects that you would do, and create a portfolio so that you can speak to it really well, and start thinking how to position yourself and try and find opportunities.
+1. It's great advice.
Okay. Another question from Bob. Are your models more strategy, like growth value, or technical bear trap, dead cat bounce? Are most technical opportunities arbitraged out and not worth making a machine learning model?
Good question, Bob. And I could go on for days on this topic. I'm going to try to make it like 3 minutes instead. So I'm actually going to go backwards from your question. Technical strategies, it goes back to that concept that I was explaining earlier, right? Trying to find, so an edge, by the way, it's like an asset mispricing that occurs more than once that you can take advantage of profitably. Okay, that's what, when I say an edge, I mean basically non-random successful trading is what I mean by an edge. Okay, in like the entire world has access to the same data and the same supercomputers, and you've got very smart people sitting around all day, every single day, with very, very strong technology and very, very fast computers, looking at every single microscopic arbitrage opportunity and edge that exists in the price data. So what you're doing when you're trying to trade technical indicators is a couple things. Number one, you're competing with a huge, huge audience, right? Huge competition. Number two, you're putting filters on random data. Like the market is basically random. So if you're trading a technical indicator, you're basically telling yourself that something about this technical indicator is amplifying the signal in this noisy random data set, which I can tell you they don't, or they basically don't. The other thing you're talking about, a bear trap or a dead cat bounce, these are like, a dead cat bounce is basically like the market tanks and then it kind of bounces. Very arbitrary, right? Like you're relying on retail investor psychology to put your money in. And the question I would have is, can you consistently do that over and over and over again to where you could consider yourself getting non-lucky? Like if you're getting lucky, then that's like working for a full month and then your boss flipping a coin and saying, you're going to get paid if this coin flips as a heads, right? You don't want to base your money on something that's based on luck. So all of that said, I don't trade. I've traded technicals for a very long time. I am not a good discretionary trader. When I did this, I was not in control of my emotions. I am now. I was not before. But I learned that this is just not something I'm strong at. There's plenty of people that are really good at discretionary trading. But the problem with when you're mixing just technical trading with like code is that you optimize and brute force optimize these indicators and you overfit. So I am trading factor-based strategies, which is what professionals do. In finance, we call them factors. In data science, we call them features. Essentially, what we're trying to do is find a feature or a combination of feature that predicts forward returns. And if we can find a feature that predicts forward returns, we build a portfolio based on the assets with the strongest correlation to that feature. Okay, that's the basic premise of how this stuff works. That is what I do, and I've had a ton of success doing that over the years.
Amazing. Okay, so this was awesome. Jason, thank you so much for coming on. I was like completely energized by this conversation. I really enjoyed it. You went so deep on stuff, and like I appreciated getting to nerd out a bit. And thank you everyone for joining. I hope you will join again next week. I hope you have a fantastic week, and thank you again, Jason.
My pleasure. Thanks everybody. I'll see you out on the interwebs. Bye.
All right, bye.